Hi guys, this is Terry with Futures.io. It's my honor to welcome Adam Grimes for today's webinar, 5 Keys to Professional Trading. The bullet points for today's webinar are, what is professional trading and why do we care? How can we align our beliefs and practices with the market? What is the role of risk in successful trading? How big of a part does luck play? How should we understand trading psychology? And what is its place in a successful trading investment process? And what can you do today to make yourself a better trader? Adam has 2 decades of experience in the industry as a trader, analyst, and systems developer. His trading experience covers all major asset classes, futures, currencies, stocks, options, and other derivatives, and a full range of timeframes from very short-term scalping to constructing portfolios for multi-year holding periods. Now, during the webinar, if you have any questions, you can type them into the questions box and we'll do our best to answer them at the end of the event. And if you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. Also, don't forget that you can now follow us on Twitter and Facebook at Futures.io. And without further delay, I'll hand it over to Adam.
Thank you, Terry. Very good to be here with all of you today, and let me get my screen sharing. And I apologize, I realized that I was just adjusting the screen on my mic while you were talking, and I think that probably went out with some noise, so apologies for that. So the topic today is professional trading. And why? Why do we care? You know, I think that's always a good thing to ask about anybody. In my mind, professional trading is something that you can build a career on. That's the difference. You know, we'll talk about some other ways to trade, and you can basically trade as a gambler taking a shot, but that's not really what we're interested in. We want to do something that we can build eventually a comfortable income and, you know, maybe even focus a lot of our lives around trading. So that's the point of looking into professional trading. So the 5 keys. The first, and I'm not going to spend equal time on all of these. Understanding how the market moves, understanding odds and probabilities, understanding risk, understanding psychology and behavior, and then the last, understanding that actions are really what matters. There are a lot of understanding points here, and this all seems to be very intellectual, but the point is that trading is not really about what you know or think or believe, it's about what you do, and that's where we're going to get at the end of this. So I will tell you, many of you know my work. For those of you who do not, I focus a lot on quantitative statistical patterns in markets, and I am extremely critical of much of traditional technical analysis. Many of the other disciplines just simply have not been able, and I've looked, you know, I've spent a lot of time looking for the edge, and I can't find it. So today I'm going to gloss over some of these things, and because I want to talk about other things. You know, I could talk to you for hours and hours and hours about patterns in markets, and this is the first part of the presentation, but a lot of this is going to be very high level, almost hand waving, you might say, just accept it, just accept it. That's just for the purpose of this presentation. If you're interested in more, I'll give you can Google anything that I talk about that you want to know more of. Just Google and add my name, you'll probably find it. I'll also give you the link to my blog, and you can find a lot of free information there. So with that caveat, let's spend a little bit of time understanding how the market really moves. And after a long career in a lot of trading, I've come to believe that most of what we see is meaningless noise. Markets are usually random. The random walk, efficient markets people, you know, there's this big disconnect between the academic world that says markets are efficient and traders that say, wait a minute, no it's not. And I think the answer is, frankly, the academics are usually right. Markets are almost always, but critically, not always efficient. And these inefficiencies come in spurts. They come in, you'll see them on a timeline. They'll come together. They'll also come in different assets. We'll see edges in, say, the euro and the pound at the same time, both against the US dollar. And we tend to see these points where the market is somewhat less than efficient, and those can offer some opportunities for profits. Another thing that I've really come to believe is that behavioral factors strongly influence the market. So we can talk about statistics. One of the things I like to say is the market is not a math problem. It looks a lot like a math problem, but at the end of the day, it's really about behavior. And back to the idea of market efficiency may be an evolving process. So certain edges we find may require, not all, but some may require maintenance, some may stop working, and this is part of the nature of the market. So the bottom line is that price movements are usually random. The idea that every tick, every single little shape of a bar is meaningful is frankly absurd to me based on what I know about how markets move. Most of what we see is random. This means it's really hard to make money in the market, but there are some patterns that let us do that. Patterns are not really enough. You know, it seems like a lot of people will point to patterns and say, like a typical path for a new trader might be to hang out in some trading rooms and see a pattern and, you know, learn a pattern on a chart and say, okay, I'm going to go trade it. But I'm going to show you here, these are random charts, and bear with me for a moment because I know many of you have seen this. This is completely randomly generated data, and this is randomly generated data that has a pretty good trend. And here's a randomly generated data series that has a nice double top. There are other features here, and if you're watching this on the playback, and particularly if you're a newer trader, pause on some of these screens and look at these and say, how different does this look from what a market? You know, you'll see a lot of the patterns. This is just a line chart, not bar chart, obviously, but you know, here's some kind of triple top. Here's a trend reversal with a nice double test the second time, and you know, I see lots of pullbacks in these. And so these patterns, the fact that we see patterns, it's not enough to tell us the market is not random. However, the fact that I just showed you random data that has patterns, conversely, that does not invalidate patterns. The key is, and what you have to do, whatever, and I think that this is one of the most important points I'll make today, whatever trading methodology, system, approach, idea, concept, however you choose to trade, whatever motivates you to get in and out of a trade, the key idea is that the pattern, the condition, technical, fundamental, macro, I don't care. When that sets up, what we're saying is that it has some predictive power in the future. And this is what we think we should be able to tease out from a back test, that if we go through and find examples of the pattern and then find out what happens after, the key point is that after we see these patterns, the market should move in some non-random way. And by the way, I hope you just noticed, please do read the slides. I'm not the type of presenter that reads every word on the slide to you. I will trust your literacy to do that, but I will talk around, and you know, I'll talk around the ideas on the slide, so make sure, please, that you do see the slides. A important idea in this testing, and when we think about testing patterns, is that we're looking for some evidence that a pattern gives a non-random expectation. You know, what would be the point if we just went and bought, you know, I mean, let's say literally you had a coin on your desk, and every day you flip the coin. If it comes up heads, you buy the market. If it comes up tails, you short the market. Now, we know that that coin doesn't actually know anything about the market, and so that's a random influence on the, you know, on your trading, and your results are going to be pretty random with that over a large sample size. So what we're looking for in all of our pattern work is evidence that it's not random, that what we see is less than random. Well, what's that look like? So let's talk about a pattern that does work. I've spent a lot of time, I find a lot of time on my blog where I'm talking about things that don't work, but here's something that does work. Stocks and stock indexes tend to reverse after multiple closes in the same direction, and this is specifically on the daily time frame. If you want to look at intraday, it might be a little bit different. As we, at the end of this little discussion, we'll also check one of the fundamental assumptions of technical analysis. If you read the technical books, if you listen to a lot of the technicians, they'll tell you you can take any tool and apply it to any market, any time frame with the same results. In many cases that's true because the tools they're talking about have absolutely no edge, so it's random, it's just going to be random. But the things that do work, there tends to be some area areas where they work better and some markets where they focus on, and I'll show you a good example of that. So let's get a little mathematical. Let's call this a test of n-day runs. And when I say n, we just replace n if you want to talk about 2 or 3 or 7-day runs. Just a general way to think about it. To understand how to think about this, let's think of a coin flipping experiment. So we have this coin that it's a fair coin. Flip it, it'll come up heads or tails, 50%. Now let's label 2 events. Event A is the event that the next coin flip is the same as the previous. Or, so if I just flipped and I flipped heads, if the next flip is a head, then event A is true. And also, obviously, if I flip tails, then the next flip would be a tail. So we're looking for 2 consecutive flips. Event B is a little bit different. Event A could be a subset of this, but I flipped a series of n heads or tails in a row. So here is the coin flip modeled with random numbers and with a very good random number generator. I'll show you. Probability of the event A. Remember, A is the next coin flip is the same as the flip that I just made. That should be 50%. The reasoning being, if you can imagine we have those 2 coin flips, a way to think about it is there are basically 4 ways those can fall, and 2 of those ways, heads, heads, tails, tails, happen to be the same. So 50% of the time, this event A should be true. So what I did was I used nuclear decay random data, which for those of you who are into random numbers, that's about as random as we can get. Your Excel will not really give you random numbers, but we find this is true in the experiment that I did 50.1% of the time for 1,000,000 flips. And by the way, just to sort of dial in your intuition about your trading and the law of large numbers, you shouldn't expect things. If I told you it was 50 exactly, you should be a little suspicious because that would actually be very unusual. So probability B of event B is I flipped, let's use 7 heads or 7 tails in a row. Theoretically, this should happen 0.78% of the time, roughly. So imagine, though, before I show you some numbers, that you do this coin flip experiment. You're flipping a coin, very exciting, right? You're flipping a coin many, many times, and you flip seven heads in a row. And I say, whoa, stop. Before you flip the next coin, is the coin special? This is the question we're asking. Is the coin special after this run, or is it still just a 50-50 shot? So what we can do to test this is go through the data set at the end of each n equal 7 run. We can flip again and see what the probability of the next flip is. So we're testing this probability of A, but now with the condition again. If the coin is not special, if it is truly fair, if math works, then we'll see 50% of the time. However, if it's special, we'll see it in the numbers. So here's what we actually see in the data. And I know it's all of a sudden a little bit of a big data table, so let me walk you through it. This is based on the 1,000,000 random coin flips, and each row is a different number of n's. You can see down the left 2 to 8 rows. Let me call your attention to the second column from the right, where it says probability of B theory. So this is the theoretical number of times we should have had this many runs in the data set. You should have had 3 in a row 12.5% of the time. The probability B observed, so this is the middle column of the table, is what we actually saw. And you can see with this many coin flips, this is very, very close. If we went out to decimal places, you would see it's not exactly. If we went out more decimal places, but it's very, very close. And then over on the right, here's the whole point of the data table, is the probability of A given B. So this is the probability at the end of each of these runs. You flip again, what's the probability of the next flip being a head, or head or tail, and you see that it is very, very close to 50% with some slight variation. So this is, and I find this is useful. This is random information, and if we did the test again, it would be a little bit different, but this helps to dial in again our intuitions into how to think about randomness, because This doesn't seem to be a really earth-shattering thing, right? But here's the point. Now let's use the market. Instead of the coin flip, let's use the market. Let's use if the S&P 500 cash is up on the day, we'll say the coin flipped heads. We'll just do the same experiment. And if it's down on the day, we'll say tails. Here's the data we get. Now, here's where things get interesting. So this is, roll up your sleeves. This is where things start to connect to trading. First of all, the sample size is a lot smaller, and you'll see that. And again, the probability B theory, those numbers are the same. In the observed column, the middle column, we start to see some interesting differences. And we would have to ask some questions. We don't really have enough information here, but are these differences statistically significant? So in other words, it seems like I would have expected to have 25% of the time 2 up days in a row, and I actually had more than that. And the same thing with 12.5, I had more than that. But then when we get out further, it seems that we have less. And we'll talk about, there's something else going on here that makes these numbers a little bit more important. But look over on the far right, which I told you was the point of the experiment. So this says it basically is the market a coin flip. And if these numbers were 50%, then the answer would be yes. The market has no memory. The market is pretty random. However, you see these numbers are, in some cases, pretty far off from 50%. So this is a rigorous, a pretty rigorous explanation of a tendency for the market to reverse after runs. Now, what's really going on here? Well, yeah, I think we see slightly more short-term runs. I pointed that out. That's probably evidence of short-term momentum. Short-term momentum. We do see fewer longer-term runs than expected, and the question is this something in the data? One of the things you need to think about is that there are unchanged days. This is a way, the coin flip is a nice model. It's a nice idea. But when we start to use real market data, we find that idea doesn't mirror reality perfectly, obviously. And in this case, it would be like the coin stands on its edge 0.3% of the time, which would obviously disrupt our stats. That's what happens when the market's unchanged. But the bottom line is from this, we see the market is more likely to reverse direction after a run of closes in the same direction. And this should give you some comfort that the market is not a coin flip, that there is a statistical edge. This is just one example. There are other examples. I do want to point out, I don't want to spend much more time here, but this is a table that shows the same test with the actual edge in basis points done for futures, forex, and then stocks, individual stocks on the left. And the first column under equities, which you see the numbers 18.4, 24.4, that's the edge. So it says that 2 days, if I was to fade, if I were to fade 5-day runs, this is a test of 5-day runs, 2 days later, on average, I would be up 24 basis points over a lot of trades. And you see for the buys, the edge is strongly positive and consistently positive for stocks and consistently negative for sells in the big bottom row, the bottom division. However, look at futures. Look at the same column in futures, and you see the numbers are very small. They don't really, they're not statistically significant, and the same thing in Forex. In fact, in Forex, maybe the edge seems to go the other way. So here is, if there is this type of fundamental difference in the way markets behave, how could you possibly expect to slap an indicator or a trading system on any market and have it work the same way? Yet technicians tell us this over and over, and frankly, it's irresponsible. It does not respond to the reality of the market. Why do we care? Yeah, I just spent 20 minutes talking about numbers. Well, randomness, here's how I think of it. Randomness is the enemy, because if something is random, we cannot base our trading on it. You may very well make money occasionally with a random idea, but in the long run, you're going to break even, and actually it's going to be worse than breaking even because you have costs. You're paying for data, you're paying commissions, you have financing costs. So all of our work centers around overcoming this randomness and finding something that's not random. Again, so I'm going to generalize here, but and check my blog if you want more information, but many of the common tools of technical analysis fail dramatically. Some can be tested easily and show no quantitative edge. When markets touch moving averages, your favorite 250-day moving average, whatever, the 200 days no different than the 192, and the 50 is no different than the 60. They're basically just numbers, lines on the chart that we attach significance to. Moving average crosses do not reliably define trends. Moving average trend indicators, many of you are probably familiar with the idea that you're going to put 3 moving averages on your chart, different periods, only take long trades when they're lined up in the right direction. What that actually does statistically puts you on the wrong side of the market. If you're struggling with a system like that, you may be struggling because you're simply trading against the tendencies in the market. Many indicators don't have an edge. Fibonacci ratios, not a shred of evidence that any Fibonacci number has any significance whatsoever. There are, of course, other things that are a little bit harder to test. There are subjective things like trend lines, different applications of indicators and way things work together. But in general, I found that very simple patterns, very simple things work, and you can read more about it on my blog. In general, I think about a two forces idea. So you have momentum and mean reversion, and the things that work within that context, and within the idea of, if I'm trading momentum patterns, I need to be aware of how that's different than if I'm trading a mean reverting pattern, and also, probably where it falls in the market structure with some, some significance. So just to sum up this section of the presentation, how the market moves. Most of what you see is random. You can't trust your sense of what you see because humans have very poor intuition about randomness. Didn't really talk about that, but that's a critical point. There are patterns in prices. Finding them is not trivial. You're not going to do it by just casually looking at charts. You're not going to do it with head and shoulders patterns or cup and handles or just casually looking at charts. Much of traditional technical analysis may be unreliable. Above all, you want to have some evidence that you have an edge over randomness. Switch gears just a little bit, but this all ties together. So let's think about understanding odds. Well, here's a very simple equation that I call the trading account equation. Your total P&L after you do a bunch of trades is the sum of what you have made minus the sum of what you've lost minus your costs. And people forget about the cost part of the equation, but one way I think about it is that you have 2 buckets of money, and you're putting money into the wins, you're putting money into the losses, and you can come up with some mental construct, negative money in the losses. I don't know what that looks like, but then it nets out, and you just hope the pile of what you made is bigger than the pile of what you lost. That's basically what we're doing as traders. It is also worth thinking a little bit about costs. Everybody's going to think about commissions, but there are other costs. There's data feed, education, other software packages that may relate to your trading, interest and financing. That's standard in finance thinking, but a lot of traders are surprised when they say, oh, there's opportunity costs. I could have had my money somewhere earning interest, which, okay, I realize in the current environment is a little bit of a funny discussion, but there are times when interest is significant. Over your career, it's an important number to think about, and certainly the opportunity. You could have been doing something else with your money or your life even. This is an opportunity cost to consider. Some of these costs don't show up on your account statement, and it's probably enough at the beginning to think about the big costs, but they're all there, and it's worth thinking about. Average trade is, so let's imagine you've been trading a while, you have a trading account, and you do know that total P&L number, and we can look at it before costs and divide by the number of trades. This will give us the average trade. So what this tells us is, quite simply, the average amount you tend to make each time you trade. If these statistics are reasonably stable, you can multiply this by the times you trade and figure out how much money you'd make. So we can project P&L within some bounds, but be careful. A lot of people, for instance, will develop a system on the daily charts, and they'll say, gosh, this does okay. It'd be nice to trade it on the 5-minute chart, but things don't necessarily scale like that. So this is, this is one of the challenges. And here's something important. A trading account is, this is when I wrote this, I thought, gosh, Adam, that's kind of a stupid phrase, but I think you'll see what I mean. A trading account is a forward back test. So, it's a real-world back test. We do a lot of back tests where we look at conditions and we see what would have happened, and we try to understand our edge that way. But a trading account is that back test in the real world, and it's a back test with all of the actual constraints. So the point is, when you do a back test, if you do everything correctly, then it will match your trading results. That's the goal. And it's helpful. I think it helped me when I was figuring out how to put all of this together to start to simply think of your actual trading as being a variation of a back test. Expected value, I think a lot of you know about this, but just this is similar to the average trade. It's the amount you tend to make or lose on each trade. The reason this, and if you're not familiar with expectancy and expected value, I want to focus on this, but you should be. If you're not familiar, this is a critical trading concept that you should Google. Start by Googling me and expectancy, or me and my name and expected value. You certainly can find a lot of other resources. You can find a lot of books. The Thorpe books talk very clearly about expectancy. Just be aware as you're crafting your trading system that there are basically two ways to make this work. One of the things that I find mind-boggling is all of the emphasis on high probability trading. People selling trading systems or selling trading rooms that are based on high probability trading. You don't need that. There's no advantage to being an 85 to 90% trader. I was a 90% trader at one point in my career for many, many months, over hundreds and hundreds of trades, and I didn't make money. So being a high probability trader is not necessarily the answer. You have to be a positive expectancy trader, and you do need to think a little bit about, broadly the two ways to do that are you can either have a very high win ratio, or you could have a very high average win relative to your average loss. And it's the interplay of those factors. I just kind of hit the extremes there, but whatever you do, this expectancy equation, expected value equation, which also is the average trade equation basically, has to be a positive number. If not, you're wasting your time. That's pretty important. So in a truly random market, there'd be no way to do that. There'd be no way to achieve a positive expectancy. We could, however, you could trade with and this is important, you could trade in a random market and get a very high win rate just by increasing your stop size relative to your target. You could use a 5-point stop and a 1-point target in a completely random market, and you'll be a very high probability trader. But you will not be a positive expectancy trader. You also could do the same thing with a day trading system that has no edge. Just use a big stop. Don't take your losses, or only take huge losses and take a lot of small profits, and then all of a sudden, magically, you are a high probability trader. And however, you won't be a profitable trader. You'll be at best a zero expectancy trader. You also could do, again, I won't go through everything in this slide, but you have to have an edge so that you can have a positive expectancy. It's impossible to overcome this constant shifting around. If you do what I said, where you have a much smaller target, and then you're going to find that you will lose enough, just often enough to offset your wins. And if you do the opposite, you say, okay, well, I must have a 5-to-1 reward to risk ratio. But people always say risk-reward ratio. Why is that? 5-to-1 risk-reward. That's not what they mean. If you have a 5-to-1 reward to risk ratio, that's not the answer either. And what you would find is that your probability of win adjusts so that you are a zero expectancy trader. And it's certainly not possible to every now and then you'll hear somebody say, I'm an 80% trader and all of my trades have a 5-to-1 reward to risk ratio. And that type of edge just does not exist. It's not possible. Critically, you have to have an edge. If you don't understand your edge, you don't have an edge. That's paraphrased from one of the Market Wizards books, one of the first Market Wizards books. It's one of the best pieces of advice I found in the market. He says you have to have an edge, and if you don't know what your edge is, you don't have one. And if you think your edge is head and shoulders patterns, or your edge is something somebody told you in the chat room, you don't have an edge. You certainly don't have an edge you can apply. And if you don't have an edge, there's no point trading. You're not going to make money. Trailing stops, money management psychology, none of this stuff's going to work if you don't have an edge. Because trading is simply an odds game. What you're doing is applying the same edge over and over. Now, all these things I talked about, trade management, entry triggers, position size, risk management psychology, your workflow, your broker relationships, your financing, all of this stuff serves the edge. I wrote here, all things serve the edge. But you have to have that edge before any of this stuff makes sense. Otherwise, we're just wasting our time. Switch gears a little bit, think about risk. So again, any of these topics, we could talk for days. I could talk until my voice gave out. One thing that was really helpful to me was to start thinking about risks in terms of the probability of the occurrence versus basically how often does it happen and how bad is it? And to kind of put these things into 4 categories. So you have things that don't happen very often and they're not very serious. We don't care about these. We're not going to spend any time at all thinking about these, but just double check your assumptions, make sure they're really not serious, because maybe things could be worse than we thought. On the other hand, we have these risks that happen all the time, but they're pretty low risk. Just some of you might think, okay, well, getting stopped out. To me, that's not really a risk, but it's that type of risk, that type of thing that happens almost with regularity, and not a big deal, a fact of life. We can't avoid many of these, but we do need to consider the impact of them in the aggregate. Now, we also need to consider the box that we're most afraid of is the high probability, high consequence, and these will blow you out of the water. An example might be massively over-leveraging your account, psychologically trading on tilt, just selling a bunch of option premium and forgetting about it. These are bad things will happen with a pretty high degree of regularity, and this is how you leave the trading game and go to some other career. So be careful with those. Where people make most mistakes are these extremely high consequence risks that don't happen very often. And actually maybe the option premium example is one of those. You can write a lot of naked premium, be naked short options without wings for a long, long time and do okay for many, many, many years, but it's very hard to, when you see this, it's very hard to think about the once in a decade thing that will completely wipe out your net worth. And it's not theoretical, by the way. I've seen that happen to a number of people. So these risks do matter. However, you need to think carefully about your relationship to risk. That's an odd thing, right? I think if an appropriate question for a trading psychologist is, tell me about your relationship with risk. Because as traders, we assume risk. But there's a misconception that traders are crazy, risk-seeking gamblers. And to be sure, some are. There are many different personalities. But I understand risk in a very rational, very reasoned way. Risk is why I get paid as a trader. But I get paid to assume the right amount of the right risks at the right time, and then to do the right thing with that risk. And so we're talking about a lot of right things. We're talking about doing a lot of right things. If any of those things are wrong, then bad things can happen. Kind of a silly way to think about it. Risk is the fuel you put in your trading engine. It's the gasoline you pour in your car, jet fuel you put in your plane. But like all fuels, there are dangers to consider with risk, and we have to really understand this. The major risk, particularly for developing traders, I think one of the biggest is you're simply doing something that doesn't work. And that's really hard to hear, and it may make some of you angry. I've had people storm out of presentations I've given in person. I've given presentations to room, and I've had people argue with me or throw things and slam desks, and I had a guy walk out because it's very hard to think about the idea. So you're not making money. Perhaps the problem is you're just doing something that doesn't work. that happens more than you would think. Again, we go back to you have to have an edge. You must have an edge. There's also a risk that market conditions will change, particularly if you are a developer of systems that are finely tuned and optimized. There is the possibility that market conditions will invalidate your system at some point down the road, and you need to be prepared for that. There's also the risk you may not be able to execute when you wish. This is one way the back test divulge from reality, and it's an important enough way that I put it on this slide that you need to check your assumptions. An obvious example might be, say you have a system that enters stocks on the open. Can you do that? Well, yes, but you have to think about it may be a little bit more difficult and you may not get the price you think. And then, of course, last, there's the risk of the black swan event, which everybody's always terrified of these tail events and black swan events, but just be aware they're not always bad for you. If you're properly positioned over the course of your career, some of these things will work out in your favor. Talk a little bit about psychology. This is frankly, I've written a lot of critical stuff on trading psychology. And the reason is because I think in the hands of many writers it's abused. Trading psychology is not an edge. There is this mindset that says you simply have to have a belief, any old belief. We don't trade, the idea is we don't trade the market. We trade our beliefs about the market. So all you have to do is have a trading system that is aligned with your belief. Now, that's odd to me because in what other discipline does that work? Like if a heart surgeon thought that he should put feathers around the heart, if a airplane pilot thought that he should land the plane, if he had a belief that he should land a plane upside down, and we could go on and on and on. The point is your beliefs have to be aligned with the market. Guess what? We're back to you have to have an edge, right? But this idea that you just have to have any belief and work on your psychology to apply the belief doesn't make sense. And many developing traders who, the point of trading psychology in my mind is to enable proper action. That's where we're heading next in the presentation. If you're trading, if you're doing the wrong things in the market, if you're trading a moving average cross system, for instance, that has no edge, guess what? You should feel bad about that. You're going to lose money doing that, or you at least break even. You should not feel good about that. There's no point in working on your psychology in a situation like that. Yet I have seen time and time and time and time again traders who come to me. I work with a number of traders in different contexts, and traders I've coached that say, gosh, Adam, I have these. I just have so much trouble pulling the trigger, or so much trouble taking my profits, or whatever. All of these psychological issues can magically be fixed by aligning the system with the market. The problem is not you had some deep-seated psychological issue. The problem is that you were doing something that didn't work. And many, many, many times the solution to psychology is to fix your trading. It's not necessarily a given that you have a good trading system and you can execute it. There still can be issues, particularly issues when we go to increased size and risk and different psychological points in our careers. Definitely things need attention, but you need to be certain at least that you're aligned with the market. Now, once you are going deeper, we do need to understand reactions to stress. We need to understand, the dream of so many traders is to trade for a living, and trading income being as uncertain as it is, that can be challenging. That can be quite difficult psychologically. So there are a lot of different realities to understand, but so much of this work really goes back and hinges on starting with that edge. It's also worth thinking a little bit about stress. Be aware that when you are stressed, the normal human, animal, caveman reaction is you get stressed, what are you going to do? You're going to growl and you're going to run away or pick up a spear and a rock and fight. It's that fight or flight reaction. But in the modern world, we get stressed and what do? We sit at the desk. We squeeze a stress ball. Maybe we watch some kittens on YouTube. Maybe we send an angry email. But, obviously these are not normal physiological expressions of stress, so these stress hormones build up in our bodies and actually lead to an altered state of consciousness. you are in, realize when you're in a stressed situation in trading, you are compromised. You would never take somebody who's high on drugs or drunk and say, here, operate this piece of heavy machinery. When you're having a stress reaction to the market, your brain is just as compromised, and you literally cannot make good decisions. So we need to come up with ways to deal with this, and this is, a major part of the work that I do with traders, and the work that I have done with myself and continue to do is based on understanding how to cope with stress and finding some constructive ways. And I'll tell you one very powerful way is meditation, which literally can change your life. And I'll point you to a resource on that. Bigger picture questions, why are you here? These matter. Who are you? Why are you here? Are there any tensions between you trading and your morality? These are interesting, deeper things that we can reflect on and think about. It's a little bit hard to do this work by yourself, maybe. But you can do a lot of it by yourself with a journal. You can perhaps do some of it with a friend. Some people do good work like this in groups, and that's why working with somebody that can reflect some of this back to you can sometimes be powerful. But this is not for not for the beginning trader. You need to be sure you have that edge first. This is deeper work that we do once we have the edge, because this will help us to enable right action. Once you have the edge, then start doing this. I hit a lot of the points on this. Journaling is very powerful. Introspection, spending some time in really deep thought, coaching, mentoring, or therapy in some cases. I think those serve very different ends. What a coach does and what a therapist does can be constructive for different people at different points. Therapy, I think, kind of deals with our past. Coaching deals with what we're going to do in the future, but these can be powerful tools that are appropriate for people at different stages. Let's think a little bit about action. So here's kind of I drew this. It was like 3:30 in the morning. I drew this, what I thought was kind of a silly chart, or silly diagram, and I said I actually kind of liked it. I made it my computer wallpaper for a while, and the point of this is that you have all of this stuff affecting your inner world. That's the blue blob to the left. I just listed a few. Your emotion, what the market does, what your friends say, even things unrelated to the market. Do you have a pet that is sick? Did you just win the fantasy football league? You have like all these things going on that affect our mental condition, and in addition, you have your years of learning and study. You have your carefully crafted system. But the point is, none of this matters. It's all behind a wall. The market doesn't know. The market doesn't care about any of this. All that matters is what you do. When you push that button, when you call your broker, when you actually execute the trade. And I think maybe this is a very obvious thing. Perhaps some of you aren't even really paying attention to. You don't think it's that interesting. But I think it's something that we miss a lot of times because we focus on all of this other stuff. But none of this other stuff matters in the absence of correct action. Really, that's the primacy, and this revolutionized my approach to trading and to understanding my own trading when, I knew I didn't get paid for thinking about the market, but it wasn't until I understood how important that action was that then my emphasis became on, gosh, let's make sure I do the right thing. Actions are the connection from this rich inner world we have to the outer world. It's how we make that inner world real. So this is why the entire trading process is designed to support this. This is why the action, to use another kind of silly metaphor, it's the tip of the spear. You have all of this supporting stuff, but the business end, the part that actually matters, is it's action. Psychological work, your trading software, desk, your computer. I just built a computer. Your homework routine, system development, even the presence and maintenance of that edge is designed to support you doing the right thing in the market. But what does that look like? Well, here we're back to two ways to make money in the market. You can be a gambler or you can be a professional trader. And if you're a gambler, I'm not going to read both of these because they're exactly the opposite. If you're a gambler, the way you gamble effectively is you take very large bets, and so big that each bet really, really matters, and maybe a single payoff, you can go buy that boat you want. Where a trader is going to take a lot of small, boring bets, and he's not going to buy a boat with any one trade probably, but also no one trade is going to take him out. And the gambler probably should make few bets. Actually, the gambler definitely should make few bets. The gambler, does it matter if you have an edge? No, not really. You're gambling. Who cares, right? But in the long run, if we were to keep doing this, we're not likely to make money. Success over the long haul is very unlikely because it depends entirely on luck. Critically, on this slide, let me call your attention to the bottom right-hand corner. If you're trading with an edge, your success depends on both skill and luck. Do not get the idea that if you're trading with an edge, luck doesn't matter. Luck matters, and it can matter a lot, and managing luck, frankly, is another presentation, but just be aware of that. So trading with an edge, to my mindset, to the way I think about the market, is the only thing that makes sense. If you want to go, just imagine opening an account, buying a lot of out-of-the-money options and hoping for the best. That's not really how we trade. It means applying a small edge many times. Trading is boring. I get concerned when somebody comes to me and says, I want to learn to trade because I think it's so exciting. Well, one of my mentors said that good trading is like being a bricklayer. You just do the same thing. You put the brick, you put the mortar, you smooth the mortar, you put the next brick, you put the mortar, you smooth it. It goes on and on and on. And there's nothing exciting about putting a brick down. There's nothing exciting about making a trade. But this is why discipline matters so much, because you can complete this edge that we talked about for most of the presentation, you can absolutely completely destroy with the wrong actions. You can have a great edge, and if you're not able to apply it, and here's where the proper psychology, proper mindset's important, you still won't make money. This, to me, is the only reasonable chance we have to make money in the long run to be a professional trader. So if you have questions, go ahead and start typing them in the box. I will do my best to get to all of your questions, ask questions on the presentation or anything else. But again, if you want to dig really deeply into the patterns where, there are some things that I may direct you to other resources, and I'll give you some of those resources. So just kind of in summary, I think 5 keys to professional trading: understanding how the market moves, understanding odds and probabilities, understanding risk, understanding psychology and how it applies to your behavior, because your actions are all that matters. Now, what can you do today to make a difference in your trading? A few very important things. First of all, think about that edge. Are you sure you have an edge? How do you know? How do you really know? How are you sure? If we were working together privately, those are the kinds of questions I would ask you to an annoying degree over and over and over. How are you absolutely sure? And the answer certainly could be yes, but there are a number of good answers. But how sure are you of that edge? And then, is your entire workflow and psychology aligned to support applying that edge optimally? Is everything you do, everything you think about, everything you are, I don't think that's going too far to say that, everything you are as a trader, is that aligned to getting you to the proper actions? Think along those lines. Some small adjustments can make a really, really, really big difference. And if you are a little bit further along the trading path, then I think the slide where I talked about some of the deeper work, some of those things can start to become very, very important. There's a lot more for you to do. There's a lot more for you to do on your edge, on yourself. Think a lot about your motivations and triggers. Think a lot about discipline, and we'll all continue to think, and I'll talk a lot more about the role luck plays. Let me give you a few resources. You can follow me on Twitter. You should already be following me on Twitter, I hope. At Adam H. Grimes is my Twitter handle. Also, you should be reading my blog. AdamHGrimes.com will take you directly to my blog. And I write a couple times a week on a combination. I'm going to write more and more in coming months on behavior, on psychology, and on performance. If you go back and look at the archives from past years, you can find deep, deep, deep dives into patterns like pullbacks and volatility, the way volatility evolves, moving averages, Fibonacci ratios. You can actually find the studies that I've done there. I did write a book, which certainly you're welcome to check out. Some people have found it very useful, Art and Science of Technical Analysis, and I do have a firm, WaverlyAdvisors.com, where I write daily market research, and would invite you to check that out. I also want to point out I have a free trading course, and this is completely, absolutely free. There's no upsell, no premium area, but it will take some of the concepts we've talked about today and take those much deeper. This is really a complete education and discretionary trading, 30 plus hours of video and audio, hundreds and hundreds pages of homework. So, if you want to learn to trade, and if you're struggling, or if you want to learn to trade and you want to get better, I think there's stuff here for everybody, and I've gotten tremendous feedback from traders for whom this has transformed their trading. And again, totally free. There's no upsell. There's nothing hidden. So here's my contact information, and I will leave that up while we do some questions.
Okay. Let's see. There is usually a lot of focus on expectancy, but that focus usually omits the importance of frequency. Would be great to hear some of your thoughts on patience, waiting for the best setups while still trying to achieve a reasonable frequency.
So a reasonable frequency, I guess the first thing that I would challenge you is I'm not sure what that means. The market is going to present us with the edges that it presents, with the frequency that it does, and we have to act when the conditions show us the edges there. As far as patience, and so I think actually there are a lot of layers to this question. Waiting for the best setups is another concept that I would challenge. I have no evidence that the best or prettiest chart pattern or the best indicator lines lined up in the most perfect, whatever confluence. I don't know that that generates a better trade. And if it does with your system, you should certainly know that from your testing. And then you could have the question, one of the trade-offs with frequency, of course, is if we widen our umbrella so we get more trades, maybe we're getting enough low-quality trades that the edge degrades. And all of this you can figure out through a combination of applying the relevant math or seeing what works in your trading plan. But as far as patience, look, let me just be blunt. I don't do you any favors if I'm too careful here, so let me just say what I think you need to hear. You have to be patient. If you can't be patient, you can't be a trader. It's that simple. And I know that sounds kind of hardcore, and I know think of it as the tough love approach, but it's very, very, very simple. If you can't stop yourself from making impulse trades, if you can't wait for your setup and take the trade, then you simply can't be a trader. And you're going to figure it out down the road when either you do eventually develop the patience or when you've lost enough money that you just quit trading in frustration. So if you struggle, I'm not sure from the question, but if you do struggle with patience, and many traders do, it's a normal thing to struggle with. If you find yourself making impulse trades, then just cut that crap out, because you can't be a trader and do that.
I was going to add, I found usually the better it looks, the prettier it is, the more likely it's not going to work. And usually the best trades look like crap. So
yeah, there's some truth to that. Well, and certainly the best trades, when you put them on, feel the worst.
Exactly.
In many, many cases. And I think there's probably a reason for this. I think part of our edge comes from when the perceived probabilities or likelihood of an event is different than the actual probabilities. I think that's where part of our edge comes from, but we respond emotionally to those perceived probabilities, even though that perception is wrong. And that may be one reason why, if a trade feels really bad, I'm not saying just go put on every trade that feels bad, but if the trade feels really bad and it is within your system, then there's a lot of validity to the idea that you may be looking at some high probability trades.
Yep. How do you find an edge?
Well, you find an edge through the only way that I am comfortable finding an edge is go ask the market, ask the data. And you can do this through some type of back testing. You do not have to write computer code to do the back testing. However, if you do manual back testing by looking at charts, there are about 1.5 million ways you can do it wrong. And that's one of the focus of I have a module in my trading course that focuses on how to do manual back testing and how to insulate yourself from the potential errors. So if you want to go, you at least have to know why would you trade if you, I mean, think about this, why would you trade if you don't know that you have a reason for getting into the trade, if you're just getting in with that, random whatever. So you at least want to know that you have historically had an edge when this happens. That's one way. The other way is to verify it in actual forward testing markets. So, I think a good development process, and what I do when I work with people is, so we'll have some kind of back test, and that we can call that fantasy land. That's what we think might happen. But then we start forward testing. So maybe you're just paper trading. Contrary to what a lot of people say, there is value in paper trading. It's a specific kind of value. It's to see if our work was done correctly on the back test and if the edge even exists in the real market. You're never going to do better in the real market than you are in a paper test or in a back test, but if it doesn't work in a paper test, you're not going to make money. Paper trading test, you're not going to make money actually trading it. And then the next thing is we trade it on very small size, inconsequential size. If you're a stock trader who, just for reference, let's say you trade 4,000 or 5,000 shares, you're going to trade it on 100 shares. Maybe you're even going to trade it on 10 shares. But the point is just so we get some executions and then we can still verify. So what we're looking for here, now we have 3 slices, right? We have your back test, you have your forward test, paper trading, and now we have some real money. Hopefully these look similar. And if they look very different, then we need to find out why. Oh, did you assume when your back test you were always going to get filled on the bid, for instance, something like that? Well, that's a problem. And once these things kind of look basically the same, and they won't look the same, but similar, and once we can see we have an edge, then we go through the process of increasing size. And that's kind of the roadmap to building a trading program with an edge. But as for how you find an edge, I have some resources out there that will point you in some directions, but I think you really need to do the work yourself, because I don't think you can be profitable with somebody else's trading system.
I agree more with that. You have to have, I think that's the reason why a lot of people have a problem with psychology in trading, is because they don't actually believe in the style or the method that they're executing. So, yeah. Let's see. How do I prevent from getting complacent after a series of profitable days?
Well, so there is this, I don't know if it's true, but at least in common culture, there's this idea that the samurai had a saying that went something like, after victory, tighten your helmet straps. And you simply, so perhaps you can create structures. I would tell you initially, you simply have to avoid hubris. You have to avoid thinking that you are better than you are. You have to avoid getting excited, because of course the classic example, and we've all done it, if I smile when I say this, it's because I've done it myself. You have a string of winning trades and you think, wow, I'm really smart, I'm going to increase my size. I can just ignore my risk management rules, and of course that's a recipe for disaster. So your trading plan, and I do hope you have a written trading plan. I hope you're not risking money in the market if you don't have a written trading plan. This is probably something your trading plan should cover. What do I do after losing days? I'm sorry, what do I do after winning days? That's actually more important than losing days. You also can work out some psychological triggers to do some pattern interrupts when you find yourself about to do something stupid because you're complacent or excited. And I guess the kind of the theoretical framework I would put around this is, we talk about fear and greed, and everybody is so focused on fear, and new traders are very fear oriented, and there's all these ways to overcome fear, but in my experience, the one that will really kill us is greed or hope. You know, where you get in a trade and you hope you're going to make a lot of money, or you know, you're excited after a string of winners and you become greedy. That's an imbalance in this fear and greed equation, and I think people pay a lot of attention to fear, but greed is what really hurts a lot of people. So the short answer to your question really is you have a trading plan. That trading plan does not change after a string of winning days, so the answer is you simply follow your plan. You follow your plan with discipline, and again, if you can't do that, you're not going to be able to be a trader. It's that simple.
Okay. Understanding all that you've described in the webinar, can you really make a living as a retail professional investor? And how many people do you think actually reach that stage?
Well, yes, of course, yes, you can. When you say, can you make a living, the question is, what's that going to look like, and how are you going to do it? I think the fantasy that you're going to open let's just put numbers on it, a $5,000 account, and you're going to scalp S&P futures and make $2,000 a month, that I've never seen that work for anybody. I don't think that is possible. But if you make a commitment to becoming a professional trader and you build a track record first for yourself, then it's very possible to think about what you do with that. You know, once you understand your trading, you can then understand what kind of leverage you can apply better. You can then look for other sources of capital. And there are a lot of ways that you can do this, and you know, certainly I know many people who transition from other careers to trading full time. And by the way, I also know people who made mistakes and transitioned from trading to other careers. So you know, just because you get there doesn't mean you've made it. It's this constant process of maintenance, maintaining yourself, maintaining your edge. That's very, very important to do. Certainly, it's possible. How many people do it? You know, I don't know. We certainly hear all of these stats that 85%, in some cases 90+% of people who trade lose money, and I suspect it's even higher than that. I suspect if you look at all of the accounts open that most of them probably lose money. But most of those people had no clue. And if you don't believe that, just go hang out in some of the trading forums, and you'll see, particularly some of the forums that cater to beginners. You will see that this is the mass of how people are trading. They're just gambling. They're taking a shot. Oh, I'm going to buy this natural gas stock because I think oil is going to go down. And and I actually saw that justification for a trade. I'm not making that up. And you scratch your head at several links there. But I think the number of people who really commit to developing a professional trading process and who realize that it will certainly take years. How many years? I don't know, 2, 3, 5. And understanding that you're not going to make hundreds and hundreds of % a year, but the idea of learning to trade professionally with consistency, with controlled risk, and building a track record, yes, you can do that. But the problem becomes, and here's why it's hard for a lot of people, it's pretty boring. It's not what people think they're getting into when they get into trading, so this may be why most people fail. If you put yourself out of that category, then you probably have dramatically increased your chances for success.
Perfect, thank you. Let's see. Do you consider fundamentals in trading?
Personally, no. But however, let's talk a little bit about fundamentals. I've done a lot of work on fundamentals. I've done a lot of modeling on fundamentals, and fundamentals do matter. I don't think they matter in quite the way people think. Like what you would find, for instance, is there's a pretty good edge to buying stocks that have a lot of debt, when many fundamental screeners would start by right away looking for low debt ratios. So there are a lot of things that kind of don't work like people think. Fundamentals also become important at longer time frames. I don't think and I don't understand at all, and I've tried to understand the mindset of people who think they short-term trade with fundamentals. Absolutely illogical to me. You know, with fundamental data with stocks, you have data that comes out about every 3 months. Fundamental data for the economy comes out every, at most every week, but most of the data points come out every month. How can you trade for a few days on something like that? So if you're a fundamental trader, I think you're a longer-term trader. I don't think you can short-term trade with fundamentals. The way that I like to trade, I've not found a stronger edge in fundamentals than in the patterns that I use and the way in the time frame I trade. So, yeah, I personally don't use fundamentals. I am not poo-pooing fundamentals in any way, but just make sure if you use them, then fundamentals are part of your edge. If you use fundamentals, it should be a testable part of your edge because you have to have an edge to trade.
Okay, which should I do first? Read your book or take your course?
I think, the honest answer is they work together. I'm not trying to push and sell books here. I think if I could only do one, I'd probably say do the course. The combination of the course and the blog and the book is really, and then with the Waverly Advisors research, I think is the most powerful way to learn, but any two of those are going to work well for you, and if you have to just do one, do the course.
Your book is on technical analysis, but you said earlier that technical analysis has no edge.
Well, that's the that's the confusion, isn't it? Because I would tell people that in basically the same breath, I'm a technical trader, but I think most of technical analysis is garbage. And I certainly think that, and you can see the test, you can see the numbers that I've done, and I've sliced and diced this so many ways. Like take Fibonacci ratios. I've done hundreds and hundreds of tests over millions of data points in different time frames, and I see no evidence that any Fibonacci ratio provides anything more than a coin flip. It's purely random. But the people that support these will simply point to examples on charts and say, oh, it looked this time, it worked this time, I made this great call this time. That's not proof. Proof is statistics over a large number of events. Proof could be Fibonacci's going forward if we were to keep a very careful forward testing record, but I don't know of anybody who actually does that and trades and makes money with Fibonacci ratios. So that's the type of technical analysis that I don't think has an edge. I certainly, in my blog and in my book and in the course and in the research, I've outlined the type of technical analysis that I think does have an edge. I'll be honest, for many, many years, I hesitated to use the word technical analysis because I did not want to be associated with the people who were telling you, stock XYZ came down to its 50-day moving average. Whatever, it's a meaningless thing. It means absolutely nothing. The 50-day crossed the 200-day moving average. So what? It means nothing. So, I tried to use different words to describe my trading, but I was always price pattern based and a blend of discretionary and quantitative tools working within price patterns. That's technical analysis, but it's not head and shoulders, moving average, Fibonacci technical analysis.
There's a couple questions. I'm going to put these together into one. What is your opinions on market volume profile, volume analysis, order flow, those type of techniques?
Order flow, I have never. So I think they're slightly different. So order flow, this is a little baffling to me. Understanding how fast the world of trading has become, and for instance, if you're trading stocks, things are happening literally faster than you can see. You're looking at an order book, you're looking at the tape, if you will, and it's filtered. You're not seeing every trade, and before you have seen it, a computer has made literally hundreds or thousands of buy and sell decisions. There is no way the human can compete on that time scale. And I think a lot of these, I'm very suspicious of these disciplines that are almost religions. So like you're taught these things and people will say, oh, you know, I can't really teach it to you. You just have to watch. You're going to pick it up after years. Have you ever heard that? Or you will hear somebody that says, I've studied this discipline for 3 years, but I don't really think I've mastered it. You've heard that, right? This is not, would you go study anything with that understanding? I can't really show you. You just kind of have to look, and you're going to pick it up, or you might not pick it up. I think what people are doing with a lot of these things is they're selling courses, they're selling things that just simply don't have an edge. The one thing that could absolutely blow what I just said out of the water and prove that I am completely wrong, if somebody could demonstrate to you that he was making consistent money with one of these approaches, and and demonstrate to you convincingly. Of course, people aren't going to do that publicly. I wouldn't really ask somebody to put a statement out there publicly, but I've spent a lot of time digging into these methodologies, and I have never seen anybody apply them and make money with any degree of consistency. So it's not something I use, and I mean, the other side of that is you don't need them.
Okay, let's see. Do the in-market test numbers change if I were to divide the data in multiple periods? I'm trying to think if the market structure changes influences that simple random test you applied.
Well, okay, so I'm not sure exactly how to think about your question. So if you're thinking about market structure, so in other words, you're going to say, I'm going to look at runs in uptrends, downtrends, or sideways markets. I would argue that that's not necessarily a valid test, because how are we making that determination? Are we going back and looking at a chart and saying this was an uptrend? Then we're applying information from the future to the past, and you compromise the validity of the test. If you had some indicator at the time that would have said uptrend, flat, or downtrend, and then you want to look at tests under different trend conditions, that is valid. And that, in fact, when people incorporate moving averages into technical systems, that's what they're doing. I just told you there's no edge to moving averages, but you will see people use them to good effect in technical systems. What they're really doing is using it as a proxy to quantify some element of the market behavior. The other question you might be asking, so I may have just answered your question, but another question you might have been asking is the concept of stationarity, which is basically the idea that if how much, I mean, just without getting too deeply into things, does the market change, or do we see the same results in different time periods? And that, that is certainly testable. So why don't you do your runs test and divide the market into decades and see if your stats look similar. With one caveat, of course, we run into, and already, this is a strange thing to think about, but one of the problems with financial data is we don't really have that much data. And I know it seems like, oh, we have so many things that trade, so many days, and we go down to intraday data, and certainly those of us who buy data and manage data, we're buried under a pile of data, but compared to some other disciplines that make good use of statistics, there really is not a lot of financial market data. And so your sample sizes will become very small with some of these tests, but it's absolutely testable. I suspect your question was more the first than the second.
With all of these advances in artificial intelligence, do you think we humans can compete with the machines?
Well, of course you can't compete with the machine on the machine's game. This is why people who tell you you have to be fast trading in and out of the order book, that's stupid. You're trading against, there are things that your big, soft, mushy brain does very, very well. There are things that your brain does that we still have not been able to replicate with computers to any measurable degree. And then there are things that a computer does much, much, much better than you. And one of those things is speed, of course. So that's why I think it would be stupid to, and I don't hesitate to use that word, it would be stupid to try to build your trading program around competing for speed with a silicon brain. Think about it like this. People pay money to have their servers co-located at the exchange, and people pay additional money to have their server closer so their cable is a few meters shorter. You pay a lot of money for that. Now, you think about the signal going through that cable at pretty close to the speed of light, more or less, and you think what time difference does it take for how much time are they cutting off to have a cable a few meters shorter? And is that worth thousands and thousands and thousands of dollars a month? The answer is yes, it is to them. So why would you play that game? It makes no sense. However, there are other time frames that we can play and other things that we can do. And that's where I built my trading. And the patterns that I trade have been very, very stable through all of recorded market history. Back to pre-World War II, we have commodity prices from the Middle Ages, and we have some price records even from antiquity. Those clay tablets that you saw in elementary school, history books, or high school elementary books, or history books. It's been a long day, I'm sorry. Though some of those were price records. They were price records from merchants, and we find that people have made the same reactions to market movements, and this is why many of the patterns do work and have worked, and I have not really had to make significant adjustments to my trading style in many, many years. So it's not something I worry about. I hear a lot of questions like that are based on fear. Here's an element of psychology, right? There's this idea that I can't take time away because they might take the markets away. And that sounds absurd, but I felt that at one time. I can't stop trading and do system development because what if they change the rules? What if they add a tax? What if they make some regulatory thing that I can't trade? Or what if the markets just change in some way? All of this is fear and scarcity-based thinking, and it gets in the way of your eventual success. There are patterns there, and you can do the work to find the patterns yourself, and you can verify if the patterns have been there for a long time, and you can verify if the patterns change. But certainly, as much as trading has changed in some ways and time frames, it has not changed in others.
Agreed. That's one of the big things I learned was the market's always going to be there. Even in the apocalypse, we'll still trade Cheetos and Twinkies, but
Yes.
There's always going to be a market.
Yep.
What would be a good whole market instrument for a novice to learn to trade on? And I'm going to add to this question, and for you, what time frame do you think a novice trader should start trading with?
Don't day trade. I would trade on looking to hold trades a few days to a few weeks. And as for what instrument, well, what excites you? Currencies, stocks, stock indexes. One of the caveats might be, or one of the gotchas might be that if you're trading futures, sometimes you want to be able to trade with very small risk. And even with some of the mini futures, the risk can be a little bit higher and the liquidity a little bit lower. So, I love the futures markets in many ways, but I think they can be difficult markets to start with. Nice thing about Forex is you can keep your risk very, very, very small. With stocks, you can trade a few shares. And each market is a little bit different. I think really sometimes I jokingly say you have to decide what kind of trader you want to be when you grow up. And I think it really is almost as simple as thinking about what type of trading excites you, what do you want to be. But in general, I would discourage people from day trading. Most people that are day trading, day trade because they're undercapitalized, and day trading is not at all a solution for that.
Agreed. I can't agree more with that. Let's see. I just saw it. Okay. When you say luck plays a factor, do you mean probabilities or that the market can change and your edge can come and go?
Well, yes. Specifically, I meant the first. The second, of course, is an unpleasant possibility, which certainly does happen with some types of trading systems. But the point is that even if you have an edge, if you have a positive expectancy, you can lose money. You can lose money over a large number of trades. And I have an example out there where I have a positive expectancy system, and I think I do 250 trades and show, again, I don't exactly remember the numbers. I show 100 different paths through these 250 trades of the positive expectancy system, and one of the traders loses money with a positive expectancy system. Many of them barely break even, and they're underwater for a long time. Had they been paying transaction costs, they certainly would have lost money, and a few of them made 2 or 3 times their expectation. So there is a lot of variability, and this is one thing that makes it hard to learn to trade. This is why I'm not a big fan of trade review, this idea that you're going to spend hours each day reviewing your trades and your best trades. Well, so much of this is very, very random that that's not a productive use of your time. A productive use of your time is understanding the patterns and understanding your edge and making sure you're applying that edge rigorously. Terry, I think you might be muted.
Let's see. There's a question here. I don't know what it is, but they're asking, what do you think of Murray math levels?
Nothing to it. I can just make that very short. Any of these floor trader pivots and the Murray math levels is a variation of that. There was one going around Camarilla, I think. It's all variation of the same garbage. You put enough random lines on a chart, they look significant. I've tested many of those, and they don't test out to be any expectation beyond a. Actually, I have a video which you can find. Google Adam Grimes random support and resistance, and I show you a pretty convincing visual example of how random lines can look real. And this is how people sell these levels. This is why people think they work, but there's no statistical edge there I've been able to find.
I'm really glad you said that, because there's actually a thread on the futures.io website that talks about the random line theory and how we can make any line appear to work in our minds.
It's very true.
So,
very true.
I'm going to try to find this question. I'm going to leave this as the last question. How did you become sure in your edge, especially when in your earlier years?
Well, in my, I guess it's kind of 2 questions. In my earlier years, I had no clue what I was doing, and I probably made money without having a very clear edge, and I thought I was making money. I didn't even understand the source of my edge. My path to becoming confident was doing a lot of back testing, and then, as I said, tying the back testing into actual trading and just seeing how all of those pieces fell together after enough time. Different people have different different approaches to this, and I would be careful with the word confidence. I am confident but humble, I guess I would say, because every time I have not been humble, the market has pretty effectively punished me. So I try to be realistic about the limitations of what I know, but I also try to then focus on the relatively simple tasks of doing the right actions to apply the edge that I do have and that I found.
Perfect. Thank you for the information today and the very informative webinar. I personally really enjoyed it, the topic and everything.
Thank you.
Thank you for the time.
Thank you. Thank you for your time.
All right.